if you look at a 100-year chart, you're talking about phenomenal wealth. In fact, every dollar put in the American stock market since 1812 is now worth more than $700,000.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me today, I'm excited to have Lior Gantz. And why don't you tell me a little bit about your background? You are the founder of the Wealth Research Group. Why don't you tell us a little bit more about your background, kind of who you are, and what your company does?
Sure. My background when it comes to finances actually has a traumatic start. When I was 13, my father's business went under, and I had to earn a living. Not that we were on the streets or anything, but the situation was that I was 13. I had my needs and my things that I wanted to accomplish. So I started working. I started first babysitting, and then I upsold those parents into letting me tutor their kids in basketball, because I was playing basketball and I was 8th grade and 7th grade and they were 1st grade. And then I started painting decks and everything. By the time I'm 16, I have like 20 grand saved up. This is 1997. I start, and around 2000, I have this money in the bank. And I'm 16. The banker is like, you're a minor, but if you get your parents to sign a waiver, we can let you trade. And this is June 2000. This is like 3 months after the dot-com bubble bursts. And it's actually a good time to begin, investing in equities.
Yeah,
I do that. So that's how I got into investing. And I asked him, how would I know what to do? So he said, the best investors in the world, people like Warren Buffett, Peter Lynch. He gave me all these names, and I started to look for them, and I started ordering the books from Amazon. This is like 2000. And that's how I started to get educated on investing, etc. at age 16. My father's second business, third business went under as well. And so my inclining towards investments was fine. And then I also want to learn a lot about entrepreneurship to see what the hell is going wrong, because I'm 23 and, his businesses went under 3 times. So that's how my family's experience in business taught me a lot about risk, made me obsessive about risk. Around 2016, after about 16 years in investing and entrepreneurship, etc., I started wealthresearchgroup.com. It's a free financial newsletter. Its basic idea is to transfer my 16 years worth of experience and whatever I'm doing on a regular basis. So if I'm reading, because I do about 4 or 5 hours of reading a day, financial and everything like that, and talking with CEOs, to congest it into an article of 5 minutes for people to read, and basically educate them about what's happening in the world macro, and what's happening more of a personalized situation, what I'm doing personally, for example. So that's a congested of my background.
cool. Crazy to think of 13-year-olds. I mean, a lot of people worked when they were, 13, 14, but they basically worked a little bit. And, maybe I had like $1,000 in the bank by the time I was 16, and I thought that was really good. To do what you did, though, is just pretty impressive. And then to have that situation, and maybe it was actually a blessing in disguise to have your dad's, businesses go out.
That's how I think of it.
Yeah. What are some of the lessons you learned through those? I mean, he went under 3 times. What are some of the lessons from that you learned?
So Todd, I think one of the things that everyone always told me was, you work too much. And that's because I started working at 13. So my mind is, you work, you earn every day. You have to earn money. So that's one thing that I developed real early, and it was really hard for me to let go of it, of that mentality of, most of my day has to be work. and it took me a long time to kind of balance it out with other stuff. So that's one thing I tell you. But I think the main takeaways for me were I never thought about what the government or stuff like that would can do for me. I wherever I landed very early on, even at 13, at 16, I started delivering pizzas, and by 16 and a half, so 6 months later, I was taking the calls for that pizza place because they saw that I can make the purchase bigger. So I started earning as a delivery boy plus as a salesperson on the phone. In one shift, I doubled my salary basically. I always thought, how can I do more for this person who is hiring me and wants to pay me more if I can deliver more, if that makes sense. So that has played out a lot in my life where I pitch a lot of ideas. Whether I was an employee at first in my career and now as an entrepreneur, I pitch all the time, just constantly ideas. Most of them not worth anything, but one of them it becomes a good idea and something that's applicable. And I think that's one thing. I call it personal initiative, that mindset, but you can think of it in any way you like. But the idea is that there's always something that can be done to expand. So I think that's one thing that's nice that I can share. That's a big takeaway. And the second thing is I like to build a relationship where I am the person that's owed and not the person that asks for favors. So I like to deposit with contacts, with my network, with everyone as much as I can, so that if I need something at some particular moment, I have credit with other people. So I like that concept a lot, and it has helped me a lot. In terms of if you can get that into your mentality, just compensate other people, give them, and not ask for anything. I think that's a great advice that I can give, and it's something that has worked for me. So
yeah, definitely. I mean, both of those. How can I do more for others, right? And then just giving more than you take. You said you're when you actually need something, then you've already done so much for everybody else. And so if that comes a time where you actually need something, they're more than willing, and you're not kind of begging for help all the time. And that's a strong position to be in, definitely.
Hi, I'm Matt Jones, and if you're like me, you're looking to grow your real estate business while connecting with others. Well, there's this incredible new virtual experience unlike any other. I'm talking about the North Star Real Estate Conference. It's coming to you online October 22nd and 23rd, and it's not like one of those boring webinars that you find all the time out there. No, this is going to be interactive. You're going to have the opportunity to network and grow relationships with the other attendees as well as with the speakers. If you'd like a free preview, we're going to have a free event on September 2nd over lunch hour. You can sign up today for both events at nreconference.com and use the code DEX, D-E-X, for $50 off.
Let's talk about your company and kind of where you're seeing things. Obviously, coronavirus and the riots, and we got crazy stuff going on in 2020, and it's been a very interesting year. Where are you seeing things? Stock market has played out really interesting, in my opinion, and in a lot of people's opinion. Real estate, just everything is kind of maybe not behaved the way a lot of us thought it would. Where are you seeing things, and kind of where do people go?
Yeah. So great question. With regards to the stock market, for example, we have to remember that, for example, the S&P 500 is 500 companies. The NASDAQ 100, which is what people follow, is 100 companies, and the Dow Jones is 30 companies. Put together, these are 630 companies, most of them multinational. And so it's not a representation of America. right? It's not, most people are not employed by these specific 630 companies.
Right.
And half of the earnings that they make come from other markets. So Europe, China, emerging market, etc. So we have to put that in context. And the reason that they are becoming more valuable, in other words, that they're priced very expensively, has to do with three things. One, the alternatives. So in other words, interest rates are zero and or next to zero. So there are less alternatives in that world for a saver to say, okay, I don't want to touch equities. I just want to make 3, 4, 5, 6% like in the 90s. Just have the bank paying me money. It doesn't work anymore. And so, and it might not work for the next decade or so. So that's one thing. That's one reason that makes companies, publicly traded companies, more expensive to own today, because you're competing. If you make 5% in the stock market, you're competing with a bond that yields 0.3%, etc. You're making a fortune. So that's one thing. Second thing is liquidity coming from the Federal Reserve. When you create new currency into the system and you allow corporations and hedge funds, etc., to access that, and pension funds and sovereign wealth funds, those entities, they're usually net buyers. So if they're not buying, they're holding, but they're not the sort of entities that sell equities. When you saw the 35% decline in March, that's because people like you and I were panicking out. For example, I'm not saying specifically me, but the public, the retail public. Those are the people that sell quickly and then resume, etc.
Pension funds, emotional buyer seller. Yeah.
Yes, a pension fund, almost by mandate, is only either in cash or in equities, but they don't sell. They either buy or just sit with the money that's coming in. So think of that also in your mind and understand that there's always a bid. It's not like in the Great Depression where you saw 4,000 banks fail and there was no pension funds, no social safety net, no FDIC. Very different experience. So the comparison between coronavirus and in terms of like the impact on the American economic machine and the Great Depression are not to be made. It's a different type of a crisis. Here, we actually told people, put your life on suspension for 2-3 months, etc. And we're still, or the government's still putting restrictions on. So different type of crisis. And therefore, I think the real problem is yet ahead of us, because some industries are not allowed to recover. A regular crisis, what you have normally is bad behavior from some segment of the economy. It's over leveraged. So credit contracts, profit contracts, there's layoffs, the stock market goes down, etc., etc. And then you get to some sort of a capitulation, and then the other way around. So credit expands, profit gets better, companies rehire, stock market goes higher, etc. It's easy to come out of it. It's simple to come out of it in terms of what to do. This is a situation where the income is what's been lost. People are not spending; they're waiting because they're not confident in what the future holds, and therefore you have a cash flow problem. And that's why the government is coming in and saying, okay, this much income has vanished. We need to replace it with deficit spending. But that goes on until August, and then what? So the real foreclosures of gyms, of restaurants, of sports clubs and all the satellite businesses, travel and all the satellite businesses. These are millions and millions of jobs that are going to get lost. And then there's a new term, Todd. It's called right sizing, not downsizing, but right sizing, meaning companies have been given. Basically have been told, run the biggest experiment of your lifetime. Send all your employees home and see how the company runs. So the companies would have never elected to do that voluntarily, but here we have it. And so companies see now, what is it like to have your employees at home? And they see that they have redundancies and people that are doing the same type of job as the other people, and they're simply getting more effective, and that helps profits, but it obviously displaces a lot of employees. So I see a lot of issues with that coming down the road in the latter part of the second part of the year and into 2021. And then you have elections as well. So it's a big mess. And here's my big theme for this. It looks like because of the elections and because of the two polarities between Biden and Trump and their camps, it seems like they have no respect for any rules of the game. They're both, if they see an angle, they go for it, and they don't think about the price that it takes on society. For example, on CNN, you see how they demonize the founding fathers. Since when is that good to do? And on the other hand, they demonize something else. So you're seeing a situation where the America is looked at just as an economic machine. Can it recover economically or not? And we don't think about America, the country, or the United States, the country. The country is in a problematic situation. People have to, in America, in the United States, this is not an ethnic group. This is not like Japan or Portugal or Spain, etc. This is not a country that shares a tradition that goes back thousands of years. What makes this democracy work is that common values. And if you lose that is a problem. So we're seeing lots of situations, lots of obstacles. America has surmounted all of these obstacles in the past, but this is to say there are bad times ahead. So I don't see a V-shaped recovery and we're off to the races again.
So what's your advice for somebody who's wanting to invest, wanting to continue, is just like, look, just stay still, watch it play out, or is it still being active? What's your advice there?
Okay, so obviously this is not an advice, right? I'm not a financial advisor or anything, what I'm telling, I never think that being in cash and waiting for the perfect moment is good, because it never. This is not a good strategy. Nobody has ever made money staying in cash, right? So what you can do is just within your own circumstances, decide how much cash you need and how much you're willing to risk. Now, equities or stocks, if you go back 100 years, Todd, there is no such thing as a bear market for U.S. equities. If you look at a 100-year chart, you're talking about phenomenal wealth. In fact, every dollar put in the American stock market since 1812 is now worth more than $700,000. So we go through these patches that we call bear markets or sideways markets, but they last a year, 2 years, 3 years, 5 years. We've never had a situation where American ingenuity has not come back. So even if you buy at a market top at the 2000, at the peak of the bubble, and you waited, you're still up. So the question is, one, can you wait? In other words, are you 60 and you need the money at 62? Or are you 30 and you need the money at 60? That will make a lot of difference on how much risk you can take, because anything can happen in the short term, but long term, stocks are pretty predictable. The American free enterprise system works. The S&P 500 will be worth as a group much more in the future than it is today. So that's question one. How much risk you're willing to take, that will decide on how much cash you're willing to invest. And then question two is your expertise level. In other words, are you looking to find specific companies that you believe have a great path ahead of it, or are you going to buy a basket of 500 companies, an index fund? So that's second. We have to remember that historically the S&P 500 returns about 8% a year. But in the last 100 years, only 4 years has the S&P 500 in a calendar year actually closed at 8%. So it's like putting one hand in hot boiling water, another hand in ice. If you merge them, it's great water to be in, but each hand is suffering from burns. And that's because one year the S&P 500 is up 25%, the next year it's down 18, etc. Overall, over the long term, it's 8%. So it's phenomenal, and nothing comes close to it in terms of passive investing. But obviously, today, in the last 10 years, Todd, there's been a real revolution how you can invest in real estate. You don't need to run around with a realtor anymore and look for 100 houses and lowball them all and find the one. Right. There are great ways today to, even with a few $1,000s, get involved in real estate and start earning passive income. Yeah. Recently, in the last few weeks, I've personally invested in debt funds. In other words, funds that what you do is you get exposure to real estate just as a collateral. You're lending money to a fund so they can run a project, or so they can advance a project, and you earn about 10%, 8 to 10%. That's the going rates today. So that's another important thing to remember. And this is without any volatility risk. This is a fixed income vehicle. So that's a second thing. A third way to do it is private lending or peer-to-peer lending. There are several platforms, really easy to do. And then there are crowdfunding for real estate. So literally $1,000, $2,000, you can do whatever you want. And platforms online, some of them very reputable and been working for years. And you can invest passive income. I think about 6 to 8% is the going rate right now. You have nothing to do with the real estate itself. In other words, you are pooling with this fund, and they own real estate. So you own the real estate indirectly, but it's not under your name, obviously. And you get the quarterly distribution. So there are many ways to get that cash flow. And what I also love to do, instead of being in cash, I love being in precious metals instead. So if you look at the past 50 years, so since the gold standard has stopped in 1971, $35 used to buy an ounce of gold. That same ounce of gold, same ounce, you would have put it in your pocket in 1971 and taken out today. It's the same. It didn't grow, didn't do nothing, didn't add value to itself or anything. It's now worth $1,800. If you would have put $35 in your pocket in 1971 and would have taken that same $35 out today, you would have seen an almost 80% reduction in your purchase power. Yep. So I love, instead of being in cash, being in gold or being in silver. I like to be in it physically. In other words, I like to buy the actual bullion and store it, but there are other ways to do it. So for me, if you have a long-term horizon, I love precious metals over cash in terms of like my position. Just look at the past 20 years, even since the start of the millennia. Gold was $250 an ounce. It's $1,800 today. So it's even better than in the past 20 years than the S&P 500. That's very abnormal for a non-producing asset. It doesn't produce anything to outperform a producing asset. And by the way, you can go to wealthresearchgroup.com/gold playbook if you want to download like a special report on gold and silver investing and everything that has to do with that.
Awesome. A lot of stuff you covered there, and I'm glad that you hit on more than just kind of the stock market. You hit on obviously metals and real estate and just different options that people can hit on. Real estate's obviously near and dear to our heart, but there's a lot of different options for people, and I think it's important that people understand that you're having your money sit in just cash is not going to take it very far, or not going to take it far at all. So
can I say something about cash, Todd?
Yeah, absolutely.
Okay. Cash is optionality. In other words, if cash is good, if you believe that the stock market is going to lose 10% in the next year or 15% the next year, and your cash will erode at 2% because that's inflation, then you're actually gaining in purchasing power compared to somebody who was held stocks. So in other words, cash is always going to be part of my portfolio because I don't want to bet everything on the stock market going up. So that's one thing. Cash is optionality. Cash gives you options. That's the best way to look at cash. But you also have to make sure you're not.
What percent is, you said it's part of your portfolio. What percent is cash a part of your portfolio for you?
Yeah, so obviously it changes, but I don't go below 20% and I don't go above 30%. So it's somewhere in there.
Yep.
All the time.
Yep. Cool. I interrupted you, so if you had more thoughts, continue on that with cash.
No, I look, the bottom line is that all of this talk is only great for somebody who already has money to invest. So the main priority for each and every person is to become a more valuable person in their place of work, in their business, etc., before they even think about investing. But here's a hybrid, right? Here's what many people are looking for, that marriage between I'm broke or I'm young or I don't have a lot, and I also want that secondary engine. Study the subject, know it well in advance, and then meet the money people. In other words, our world right now is very much like this. There are people that they have nothing, and there are people that have a lot and are looking for ways to deploy it. You can have nothing in terms of monetary value, but because books are so readily available and information is so readily available, for $2,000, you can probably get a list of books covered that gives you an entry into the world of people of wealth. In other words, you can go from 0 to 100 very quickly. If you're willing in the next 30 days to spend all of your time basically reading, man, in 1 month you're a different person. And so that's why I started wealthresearcher.com, because I think the value of education is enormous in today's age.
Yeah, super valuable, obviously. And I mean, people spend so little time on education, and then they wonder why they're broke. They wonder why they're not getting ahead. And well, you're not changing because you're not changing. Like, you're not putting in the effort. You have to put in the effort. So I got a couple last questions before we wrap up. What's one of the biggest mistakes you've made, or bigger mistake you've made, and how have you learned from it?
In terms of investing, I would say falling in love with a thesis and thinking that because the logic of it is good, that's what's going to happen. Yeah. So I don't do that anymore. In other words, right now, even if I subscribe to some thesis, I rather not predict. What I rather do is look at present, what's happening, and bet on the present. In other words, if I have money today, what's my best option today? And not, hey, if this and this happen, if Biden gets elected and then he raises taxes and then he does this, then that will happen. I don't do that anymore, because it just doesn't work. Buffett famously says, any company that hires an economist has one employee too many. And the forecaster tells you more about himself than about the future. In other words, you would know what his personality is, but it doesn't mean anything about the future. So I like to focus on what's happening right now and how I can find value and not think about the future. And secondly, so that was a huge mistake. That's how I lost money. And to exacerbate that, not using a stop loss. In other words, thinking everyone will come around to my thesis. And so you let that investment go down because you're not willing to admit, I was wrong. Let me just cut this thing loose, and that's it. So right now what I do is I only allow myself to invest 3 to 4% in any idea with a 30 to 40% stop loss. So in other words, even if I go big and say I'll put 4% of my portfolio in this company, which on a, let's say on $1 million portfolio, that would mean 40 grand, then I would put a 30% stop order on that. So in other words, the most I would lose is $12,000, which is 1.2% of the entire portfolio. And you can live with that. Okay. What you can live with is what happened to Bill Ackman, for example, where he believed in Valiant so much that he almost lost all of his billions and his career and his reputation and everything. So that's the difference. And that is really key. Now, there's times to be a pig, right? To say this is money on the floor. But you have to realize that this has to be hedged. The worst thing is to have a catastrophic loss, because that leaves residue here, and then you're been out of shape. Now you think everything is going to collapse on you.
Yeah.
And you don't want that. It takes time to get rid of that mentality.
Yeah, for sure. Yeah, great advice. I mean, I've made that mistake too. You fall in love with the kind of a thesis that you've created, that you've made, that's sound. It makes a lot of sense, and especially in your head, it makes a lot of sense.
Yeah.
And then you go with it, and you follow it, and
sure.
And maybe you don't even lose money. Maybe you just went the wrong direction, and the market takes the other turn, and you lost out on opportunity that if you were paying attention.
Lost time, or lost
time.
or just underperformed what's happening.
Yep, absolutely. What's a favorite book? You've mentioned books that you like to read. What's a favorite book for our audience?
First of all, I if I can, my 16 principles that are literally my Bible. If you go to wealthresearchgroup.com/me, like ME, you can download them. That's the principles I live by, and I created them through all the books that I've read. I would say that I read once a month the same books over and over. And all of the Napoleon Hill books, I just read them over and over. I probably read them over 100 times. The one that I really like is called The 17 Principles of Success. It's not well known like Think and Grow Rich. Now, Think and Grow Rich, which is it's the best-selling personal development book of all times. That is 13 principles directly about material wealth. When he finished that was 25 years of his life researching. He said some of these rich people, some of these billionaires, like Henry Ford, like Carnegie, like Rockefeller, he couldn't stand part of their personality. He literally said they're materially the wealthiest people ever, and they know how to make money, but they don't have a great life. And so he created another book called The 17 Principles of Success, and that is like a more holistic success, like in everything. So, and it's not as well famous, but I would say it's a better book. So I love those books. Napoleon Hill, if you start with that. And what I love about Amazon is once you click that book, it says customers have also bought this and this and this. So you can you can start there. The best investment book I've read is The Most Important Thing, Illuminated. That's the name of the book, by Howard Marks. And Howard Marks is a billionaire hedge fund manager. And that is a great book for a beginner and for someone who's been around for a long time and needs those, those core principles sunk in again.
Awesome. Last question before we wrap up. What are your 3 pillars of wealth creation?
Well, definitely active income is by far the one that most people struggle with, right? Investing would be really not a big issue if you would have the income that you want, right? Most people don't have the income. I think that is the first pillar. And that has a lot to do with 2 things. Expertise or specialization. In other words, if you can crack how to be like the most indispensable person in the company that you work for or in the business that you're running. literally indispensable. Somebody that writes his own ticket, that can demand compensation, that has no replacement. And that takes a lot. Takes a lot of thought, a lot of practice at sometimes, but that is the main pillar in my opinion. And what I think people are missing is they initially, when they start out in life, they search for what is an industry that I know people that make money in, instead of what am I good at. So so many people, when I was 22, they were saying, I'm going to study law or study this. And I said, have you ever been to a law practice and like saw the day to day before you're going to commit your next 40 years to practicing law? Maybe you hate it. Yeah. And so I think that's the skill, and then something that fits you, and that's what most people are missing. You see them at their 30s and they say, I don't like it. That's why I don't put all my energy into it. But they're so invested in it because they spend like 10 years or 15 years of their lives in it. They don't have the energy to wash it out and change. So that is, I think, the first pillar: skill and to fit and to create the active income. The second pillar is investing for growth, in other words, cash flow. And the third is investing for preservation. In other words, asset classes that tend to be inversely correlated with these growth assets, such as precious metals, such as other things that we cover that help you in times where the stock market is down, et cetera, et cetera. These are up, actually. So having that combination. So preservation plus growth.
Awesome. Well, Lior, how can our listeners get in touch with you, learn more about what you got going on? You've given us your website, wealthresearch.com, and then the link /me. How else? Is there any other ways they can get you, or is that the best way?
So it's wealthresearchgroup.com.
Wealth Research Group, sorry.
Yeah. So that in the homepage, you can subscribe to the newsletter. That's literally the best, our best service. That's how we communicate. If you go to the website and you see on the top menu, there are a couple of tabs which might be of interest. One is called Special Reports. That's literally like a library hub of many PDF downloads on many topics that you can freely download. So that's the other way that I would say is a great way to get started. We also have a YouTube channel, obviously, with a lot of interviews. We constantly interview great people. Just wrapped up an interview with Robert Kennedy Jr., for example. So many myriad of people. I like interviewing all sorts of individuals.
Awesome. Well, we'll put that in the show notes. Any last words you want to leave our audience with?
No, we're good.
Awesome. Well, you have a fantastic rest of the day.
Thank you, sir.
Thanks for joining us.
Thank you for having me.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.